You're listening to The Move with Jarrod and Michael Ray. Conversations exploring why healthcare real estate is moving from alternative to essential, and how smart capital is making the shift to one of the most overlooked asset classes today.
Mike, how you doing today?
I'm doing great, JD. How are you?
Good. Good to see you, my friend.
Even better to see you, pal.
It's good to be seen. So we've, past couple episodes, we've been talking about healthcare real estate. We did a bit of a deep dive into the medical arena last episode,
right.
Outpatient. We're going to do a deeper dive in some new episodes coming up. But I'd like to talk about senior living. As we've discussed, senior living is a part of our overall investment thesis regarding healthcare real estate. And we're currently at an inflection point in seniors, a bit of a crisis time as well, where we have aging demographic that is rapidly accelerating. We have a supply crisis, and we have massive capital needs and investment opportunities in the space. You spend a lot of your time talking with a variety of investors, from high net worth to institutional investors, and you're really on the data of what's going on. Is there a problem as we think about it, or do we not have to worry about anything right now?
No, we absolutely have to worry about things. And we've found that the data is actually a critical tool to communicate that message to the capital base, both on the debt side and on the equity side, because there is, for better or worse, it's just the practical reality that we encounter, a stigma associated with the space that is born in large part out of personal experience by the capital playing field in this space over, the last 15, 20 years. That experience, has occurred alongside of a continuum. So the best way in which to counter that, or to at least position ourselves to effectively explain the inevitability of the opportunity and what we have great conviction around, is to lean into those stubborn facts.
And what are the facts right now?
Well, there's two key sort of data categories that I would look to kind of, make the bed, if you will. And fundamentally is the shifting demographic. I mean, we've talked about it in prior episodes in a sort of generality in terms of how, the over 65 population is growing, but to just put specific numbers to it, our latest data informs us that 11,400 people turn 65 every single day, starting in 2025. That's every 7.5 seconds, someone is turning 65 in the U.S.
Did you do that math in your mind just now?
No, it turns out that I have people do math for me, and I have an elephant's memory, so I can just commit that stuff. It's like, that's why Jeopardy
I love
has me there. But I do know 86,400 seconds in a day. So that helps us get there. But because you have that exponential J curve of population growth, that exacerbates the supply context of senior housing and senior living in particular. So much so to the point that Nick, which for those not familiar with senior living space is sort of a CoStar equivalent for the sector and the space, projects that we need to be starting construction on 40,000 units of senior housing every year for the next 10 years, just to keep up with the new supply in terms of customer supply, the people turning 65, just to keep up with them to provide that sort of fundamental base of shelter and access to care. The challenge, my good man, is if you had to guess how many construction starts in senior living were started last year, bearing in mind,
in 2024,
in 2024,
yeah,
we need to be doing 40,000 across all sort of categorical types of senior living.
Yeah.
What would you guesstimate?
15,000.
That'd be in most situations, it'd be an overly conservative sort of low play.
Yeah,
it was a
tough year.
It was a bit of a leading question,
right?
As well, because I wouldn't have asked it if it would have been 39,000.
Yeah.
The reality is across all aspects of senior housing, there was approximately 10,000 units, and within the sort of full continuum communities. So those are the communities that integrate, each of the sort of core, care acuity points. So independent living, assisted living, memory care. It's less than 3,000.
Wow. Okay.
So you're talking less than 10% of the necessitated inventory in terms of starts is getting delivered, which means that deficiency shortfall is just compounding for the next year. So we're even further behind for this year than we were last year. And so that begins to sort of, compound on itself and further exacerbates the situation. So, one of the illustrations that we often use is, you show this sort of image of a container ship, loaded down with all of its cargo and, setting out on its journey, and it's getting pulled out to sea from port, by the little tugboat.
Yeah.
And I like that graphic because it illustrates the magnitude of the shortfall. Like, we need to be building the functional equivalent of that cargo ship, yet we can barely manage the tugboat.
Right. Right. So why do you think that is? Like, what's the problem in the market where we have such an imbalance right now between the demand and supply and the amount of units that just started construction last year? What fundamentally is the issue?
Yeah. It's interesting because, again, going back to the data, this isn't necessarily a phenomena that is recent. There was a supply, I won't go so far as to say glut, but there was sufficient and adequate supply probably 15 years ago. And so starts and deliveries for communities were already sort of declining kind of in the 1819 sort of time period. But if you look over it historically, it had that natural ebb and flow that you would see in multifamily as well. You have a period of increased supply. You need the time for the absorption to sort of take hold and then create opportunity for new supply to come on. So it's this nice sort of, equilibrium as between supply and absorption. In the seniors context, it was exacerbated by a couple of things. One, you have the stigma associated with the thing, investors and capital saying, this is less of a real estate play and it's more of an ops play, and I don't have a good feel on this kind of stuff. And they had been either burned or had challenges with previous investments. But then the onset of COVID really, threw a wrench in the system and took what was already a declining supply base and accelerated that. Because as the existing communities were, emptied or had occupancy challenges, that existing occupancy or that previous occupancy needed to come back before the new supply could be justified just from an investment perspective and an economic perspective.
Yeah.
And then you further exacerbate it by the challenges we've had in the capital markets.
Yeah.
So that's just sort of one aspect of kind of the constraints that have been limiting and lending itself to these challenges.
I'm seeing something else too, though. In addition to the capital markets that you're talking about, the experience that a lot of people went through during COVID, and we may want to dive into that a little bit. We're in a market last couple of years where the inflationary pressure has been extraordinary.
Yes.
And so I think it's difficult for developers not only to raise the capital, though we've figured that out over the past couple of years of how to raise capital for well-conceived senior living development projects, right?
Right.
But it was challenging. And it was challenging because finding the optimum site based on a lot of different factors and how we're looking at the information and the data, high barrier to entry markets, significant need, lack of supply, managing architects and contractors to hit these budgets. Because it's true, I think, around while these numbers of seniors that are aging rapidly in the United States, some can afford different economic, or I should say different economic tolerances related to some of the senior housing. So aside from the challenges being a capital or reaction to COVID and some very tough times, we're also just dealing with pure cost and inflationary pressures. So how does that get mitigated in a way that makes sense for an investor?
Well, it's interesting because there are a number of different ways that you can kind of mitigate those costs. One, being disciplined in terms of how you, source your opportunities, select your site. But if you think about some of the bigger drivers that are informing where seniors needs to be going, by the very exercise of moving into high barrier to entry markets, you're going to immediately increase your land bases, right? And there's other aspects of the consumer side of it in terms of where you're locating these communities that inform that something. But let's sort of set that aside for a moment and speak more to kind of what I think you're getting at, which is it isn't just a case of things are more expensive. I think that there has also been a disconnect between the capital and us as developers in terms of the cost basis associated with it. Cost basis for senior communities has always been higher than in the multi-context because you're doing two fundamentally different things. Perfect example of that is about 30% of any given senior community, certainly that we develop, is dedicated to common areas. And the fact that you have to integrate and incorporate a commercial kitchen. Well, that's going to necessarily and understandably add a layer of expense that you're not going to get in a traditional multi-family community. You're also going to need to be building to a higher safety standard. So the decisions you make around your materials and how you integrate those into your community, are you going to go fully non-combustible? Are you going to do partially, wood frame and partially non-combustible? Like, what are the decisions you're going to make? And, to your point, to sort of mitigate those kinds of things. So, but I think it starts with kind of going back to the basics in the beginning and deconstructing it so that the sticker shock associated with a senior project is almost debunked in some ways, to kind of get across that message that the incremental cost associated with this product is no different than the same incremental cost that's getting experienced in other asset classes and other development projects.
Right.
So I think that's part of it, is kind of that fundamental education, or in some instances re-education process.
Yeah. So we've identified the demographic trends. Those are etched in stone. We're identifying these supply gaps that are occurring right now. There's definitely a less, I shouldn't say demand, there's less new product that's coming online. What is going on with the existing inventory of seniors right now? Because isn't that competitive to, I think it's competitive to some of the new developments that are going on, because you have communities that are already built and in existence that were built in the 80s and 90s, 2000s. What's wrong with those?
No, it's not that there's anything wrong with them so much as it's apples and orangutans.
Okay.
When you are trying to make a determination as to, is it more accretive to buy or to develop? We can talk all day long about the spread and the risk premium as between the two, but when you are assessing the existing inventory, I think there is a need to have a baseline understanding again of, what am I buying into? And you said it, you're talking communities that are in many 70s, 80s, and 90s. And my basis there is back to one of those old stubborn facts. Over 65% of the existing inventory is 25 years or older.
Yeah.
And so these are communities that were located, designed, and constructed in a very different contextual environment, irrespective of the cost basis.
Right.
And the fact that those communities now are trading where they are too.
I think it feels somewhat akin to what's going on in medical, where consumers have a choice. I mean, I think about my own family. So my mother is moving into one of our senior communities that we are developing. And we looked at, before we decided to develop what we're doing down at Lone Tree, we toured the market and looked at, I bet, 10 different communities, none of which were appealing. There's been a shift in the consumer, I think, interests of what a community is today.
And they weren't appealing. Why? Because they were the same? Because they didn't have something that you were looking for?
Lack of amenities.
Right.
Some single story,
Right.
a couple, 2, maybe 3-story product. Not that there's anything wrong with that, but they were just older in design, smaller units. They didn't have the common area spaces. So my mother, just as a case study, N of 1 for me, was I'd rather just stay in my house than do this, until she saw Lone Tree. It's a completely different experience. We're talking about a quality senior living community that is well amenitized. She just toured it for the first time last week, and she was blown away by, first, the experience going into the community, which is why we named our senior living company Experience Senior Living. But having that moment where she looks at the grand entryway, where you've tried to throw the leaves up that are up there.
It's fantastic. Right? I encourage you to try that.
I'm not going to do that. But she said, I can't believe this is my home. So now one of the biggest challenges that we've had and I think seniors has in this space, because in most cases penetration rates are 10, 11%. So we're competing with people's homes because there hasn't been a better solution out there. I think part of the issue has been having groups organize this development and operations in such a way to create a community in which the consumer can now look at their home and they can envision, I can see myself living here and thriving here, which is different than history has shown us because of the stock. And so times have changed. And the choice.
Which doesn't exist.
It doesn't
exist. And I think the amenitization and that, right? That is a big part of, a conversation around, the consumerism and what is the end user looking for out of its experience. But I think what you're speaking to, and especially as we think about it in the context of this extreme supply demand gap, I'll use another parallel, because on the consumerism side, I like to use the parallel to, the shift in transformation of the multifamily space, as millennials aged in. Here I go back to, and I'm reminded of the story of Kemmons Wilson, founder of Holiday Inn, right? What gave birth to the idea that the roadside motel or that sort of experience needed to change? It was because, if you looked along sort of the spectrum of choice, you didn't have any. It was Roach Motel, or nothing.
Right.
And so what was your choice, or what was your decision? I'll keep driving.
Sure.
But if there was an opportunity to create an alternative, to create that environment that you were talking about, that said, as I embark upon this family vacation, and we are going from place to place, if I have a reliable place that can even meet a modicum of the standard to which I am accustomed, right? So it becomes a relative exercise, and that relativity and that segmentation, for lack of a better term, in the market is also an extreme void, and something that I don't think, it's not only the end user and the customer hasn't experienced, the investor hasn't experienced that either.
Right. So, and I think we're starting to see a shift in investors and what investors are looking for. Where are the opportunities to put and invest capital? And why would one community be successful over another community? Because why we talk about the supply gap, we're not talking about just building boxes.
No.
Right?
No.
We're not talking about building single story, the old model where people go, just be candid, to not thrive, but really they go there before they die.
Nor are we talking about building the Taj Mahal.
And we're not talking about building
Right.
a Taj Mahal, but there's a sweet spot that appeals to today's customer and consumer that is different than before. And now we're seeing some very savvy investors look at the space and say, I need to understand, now I'm seeing the physical environment going into the communities that you're developing. I'm blown away, and you're developing at this cost basis. That's amazing. And we understand the demographic data, right? And so, but why the operations? Why should I invest now? And we're seeing some of the institutions and high net worth groups come to the table because the timing feels right. Why do you think that is?
I think the timing feels right in part because the competitive asset classes are experiencing the challenges that they have historically experienced as economic cycles run their course.
So how has seniors then?
I think that's one reason.
Well, stay on that for a second. How has seniors performed over a 10, 12, 15-year period in comparison to some of the other asset classes? So if I'm an investor and I can deploy capital in whether it be office or industrial, retail, et cetera, multifamily, why seniors, and how is it performing?
Yeah, the short answer is, best in class, one of the most overused terms of art ever. But my basis for that claim is when you look at the NACREIF index over all of the time periods that you described, that sort of 5, 10, 15, and 20-year time period, there are two asset classes that over a 20-year period have outperformed the NACREIF index, and that is industrial and senior housing. Multifamily, retail, hospitality, other, those all lag the index. And then if you sort of isolate it and look at the data, on a perfectly organized chart that shows the various time periods, senior living as an asset class in that context has outperformed just about every other asset class over short, medium, and long-term periods. So the returns and the performance are there. Again, it speeds back. When we started in episode 1, we spoke to the cycle resiliency of the healthcare asset class. And I suspect that is yet another example of the sort of lack of information or just sort of unknown knowns that is attributable to the space.
Is this another asset hidden in plain sight? Right? I mean,
one might say that.
And I wonder if it's because of just most people's experiences with some of the older stock. I'm just curious about that.
I think it is. And again, it could be a function of time. Right. Timing is everything.
Right.
COVID was challenging. And, just as the GFC was challenging in 9 and 10 until that sort of recovery took hold. I think what made it more challenging then than now, and where capital, that opportunistic capital, sees the opportunity, is because the demographics weren't quite there then.
Right. You're talking about the 11,000.
The boomer generation. Yeah. The boomer generation was in their late 40s and early 50s. Then.
Right.
They were experiencing the GFC in a very different way. Still worked out in terms of sort of net worth that they've been able to accumulate, even in sort of the wake of that, which is great because that informs why the opportunity now, that sort of paradigmatic shift that creates the opportunity to look at seniors in a new light.
Yeah.
Because occupancy nationally, even with the functionally obsolescent inventory, has recovered to historical highs.
And numbers have bounced back since COVID.
Absolutely.
And COVID was a tough time. As I reflect back on COVID and going through COVID, and I think as a healthcare developer, we had an opportunity to understand a little bit more what's going on in the marketplace, meaning that this isn't just an environment, a home, it is about care. As I think when COVID started to really explode, one of our shifts quickly went to care, care, care. How do we protect residents? How do we protect caregivers? Because people were relying on us. And I think successfully navigating that taught us a lot. Did we come out unscathed? Absolutely not.
Right.
Because it was
unexpected.
But I do think we came out with a new appreciation and a new way of operating that we had a little bit of an advantage of working with our medical clients throughout all of these years who are deep in care models that helped us be more resilient during that time. That in turn has really helped our investors who've been invested with us during those periods of time. And we've benefited from those investor relationships too, because it has been a very strong partnership to make this work, especially when times are tough. What we saw then is we saw a lot of people exit the space.
Right.
And I wonder if that has had an impact to the supply issue too, where for us, we've doubled down in the sector because we've seen the opportunity, we've seen the demographic, we've seen the supply issues, and we have a keen understanding of how to put these transactions together in such a way for them to be successful. And so I'm just reflecting on that time because it was tough. It was tough across the world. It was really tough in the space. Do you think investors today have a bit of a hangover from that COVID period related to seniors because of that operational piece? I used to feel that way a couple of years ago about some of the institutional investors, but it seems like it's green light for a lot of institutional investors in the sector.
I think so. And to your point about the hangover, it's a it's a very good analogy because the response or the encouragement that I would love to give the capital that's suffering from that hangover is your classic, New Orleans, remedy. It's a little bit of the hair of the dog. Mm-hmm. You got to get back on the horse that bucked you, because those trends, that data is behind it. There's also the macro trends associated with just this sort of fundamental psychological shift in how we receive healthcare. Yeah. The emphasis on wellness and creating this age in place. Because again, it's needs-based real estate.
Right.
So if it's not there, we need to be building it, because if it, you need it when you need it, so to speak.
With everything we've talked about then, Mike, what's the move?
I think the move is to get on board. And I know you've said that in the context of other things, but again, because of this paradigm shift that is occurring in the space, that is the very thing that creates the opportunity and necessitates doing more than just dipping your toe.
Yeah, I love that.
What's your move?
I don't think there's been a time in our history that we sit here at such a strong inflection point with these type of market demand drivers and the supply imbalances and a lack of capital that's been in the space. So I think for the savvy investor, your time is now because of what's occurring in the marketplace. I think that's the move.
Time's now.
Time's now, my friend. That's a wrap.
Thanks for listening to The Move, a show exploring what's shaping the future of healthcare real estate. If you liked what you heard, follow the show and share with someone you know looking to make their next move.